Gold has had the best year between conferences since I can remember. I remember at the last conference, there was a lot of discussion about whether or not gold would make it above 2,000. I was one of the people there that thought that it would. Of course, I wasn't the only one. It was a gold conference, so there were people that thought gold would make it above 2,000, but it was below 2,000. And between that last conference and this one, we've had this explosive rally. You would think, oh, there'd be a lot more excitement, a lot more enthusiasm, but not really. I mean, I really couldn't tell much of a difference between the environment this year and the environment last year. I mean, there's just not a lot of excitement yet in the gold market. Despite the fact that gold actually rose almost 4% on the week, it closed at 2,715. So back above 2,700, we're only about $35 below where we were when Trump surprised the markets, or maybe not surprised them, but Trump won. And that inspired a big rally in the dollar and a decline in gold. Well, gold has almost recovered all of that. In fact, if you look at its record high from a couple of weeks earlier, we're only about 2.5% below the all-time record high. I know that Scott Bessent has reiterated his belief that the U.S. dollar should stay as the reserve currency. Now, of course, he's not going to say the opposite. I mean, it'd be ridiculous to say the opposite. But I think the markets are probably going to take that to mean, oh, well, I guess we're going to have the strong dollar policy, a return to the strong dollar policy. But we never really had a strong dollar policy. It was really rolled out, I think, under, was it Clinton where we first had the strong dollar policy? I mean, it was a long time ago. Yeah, maybe it was Bob Rubin. But the strong dollar policy was basically repeating the mantra that a strong dollar is in the national interest. So every time the Treasury Secretary spoke about the dollar, or he was asked about the dollar, the response would be a strong dollar is in the national interest. And that was the strong dollar policy. I mean, that was basically the extent of the policy. But for some reason, it worked, right? Even though we didn't actually do anything, supposedly we had a strong dollar because of this policy. I used to joke about, I think I wrote something about it in my first book. I think I remember saying, talking to a student and, he cuts classes, he smokes pot, he doesn't study, but he tells his teacher he has a straight A policy, right? And so I should get A's because I got a policy that says I get A's, but you don't follow through with it in your study habits. Well, the whole time we had a strong dollar policy, everything we were doing was undermine the dollar. We were running big trade deficits, big budget deficits. So we weren't pursuing policies that were consistent with a strong dollar. Just like if somebody cuts class and doesn't study, they're not, their study habits don't jive with their straight A policy. But somehow they would just expect to get A's anyway because that was their policy. So we were just expecting to have a strong dollar, even though our policies would result in a weak dollar. So even if we go back to the strong dollar policy, there's really no policy to go back to other than just, speaking about it, right? About the strong dollar. But I think that Trump and Bessent actually want a weak dollar. They want the dollar to stay as the reserve currency, just at a lower exchange rate, because they believe that a lower dollar would make the U.S. more competitive in international trade. That one of the reasons that we have these big trade deficits is because the dollar is overvalued, and that a lower dollar will help our global competitiveness. Now, the problem is, we've had a lower dollar in the past, and it didn't help. In fact, I think that a weaker dollar is actually going to backfire because it will make our imports more expensive, but we'll keep importing them because we don't produce an alternative. That's also going to be the problem with tariffs. And, Bessent is in favor of tariffs. I mean, obviously, that's probably a prerequisite, although I think his approach may be a bit better than Trump's. I've read some stuff where he thinks they should be broad-based and not just targeted to any one country, and that maybe they should be introduced more slowly over time so that the markets could get used to them and prepare for them. So that would be a better approach. Of course, it'll raise less revenue for the government than the higher tariffs would. And therefore, the deficits will be bigger because we're still going to get all of these spending, all these tax cuts, rather, that are being advocated, which is going to make Bessent's job that much harder.
The narrative around gold and silver is changing dramatically, but the mainstream media and financial analysts seem oblivious to the seismic shifts occurring in these markets. Gold has had a stellar year, quietly moving past milestones that, in any other financial asset, would have set off alarms of excitement across trading desks and newsrooms. Yet there's barely a whisper. Why? Perhaps because the implications of rising gold and silver prices challenge the status quo of fiat currencies and the illusion of economic stability. Take, for instance, the fact that gold recently closed at $2,775, marking a 4% increase on the week, a substantial move for such a traditionally slow-moving asset. What's more, in terms of the euro and British pound, gold has already reached all-time highs. For global investors outside the US, this is not just a signal, it's a clarion call that fiat currencies are faltering and real money, gold, is reclaiming its throne. Why is this not front-page news? The financial media has become distracted by fleeting stories, particularly the speculative mania surrounding Bitcoin. When Bitcoin reaches a one-month high, it dominates the headlines, yet gold making near-daily record highs in multiple currencies barely registers. This misalignment is not just puzzling, it's a clear indication of where mainstream priorities lie, on short-term trends rather than enduring value. Let's look at the fundamentals. Gold's rise isn't just about safe haven demand, it's a reflection of deeper economic realities. Central banks around the world are quietly buying gold to hedge against the inevitable decline of the dollar. At the same time, private investors remain largely absent from the party. Gold ETFs, for instance, have seen net liquidations this year. The public is selling, yet prices are rising. So, who's buying? The answer is simple. Central banks and nations like China, India, and Russia. These entities understand that the global financial system is on shaky ground, and they're preparing for a future where trust in fiat currencies may collapse. Much of gold's current lag in US dollar terms can be attributed to the dollar's recent strength. The dollar index is hovering near a 3-year high, bolstered by expectations of economic growth under the Trump administration and a perception of fiscal responsibility. However, this narrative is deeply flawed. Historically, the US has undermined its own currency through policies that prioritize short-term economic gains over long-term stability. The so-called strong dollar policy touted by politicians is nothing more than a hollow mantra, unsupported by fiscal discipline. Consider the trade deficits, budget deficits, and ballooning national debt. These factors are not consistent with a strong currency. A weaker dollar may temporarily boost exports, but it will simultaneously make imports more expensive, a critical issue for a country that has become heavily reliant on foreign goods. Tariffs, another favorite policy tool, further exacerbate the problem by raising costs for consumers without addressing the underlying structural issues. While gold garners most of the attention, silver is quietly positioning itself as the dark horse of the precious metals market. Silver prices have remained suppressed for years, thanks in part to manipulation in the futures markets. However, the fundamentals for silver are arguably even stronger than those for gold. Industrial demand, particularly from the solar energy and electronics sectors, is soaring. At the same time, investment demand is picking up as more people recognize silver's dual role as both an industrial metal and a store of value. Tom Kaplan, a prominent figure in the silver space, has gone on record predicting triple-digit silver prices in this cycle. While that may seem ambitious, consider the structural deficits in the silver market. Supplies are shrinking, secondary stockpiles are drying up, and demand is only increasing. Silver is essentially the uranium of this decade, a commodity with immense upside potential as the market realizes its critical importance. As we move further into this era of economic uncertainty, the case for gold and silver becomes increasingly compelling. These metals are more than just investments. They are lifeboats in a sea of fiat devaluation and geopolitical instability. Whether you are a seasoned investor or a newcomer to the market, now is the time to act. The opportunities are immense, but so are the risks of inaction.
Gold has had the best year between conferences since I can remember. I remember at the last conference, there was a lot of discussion about whether or not gold would make it above 2,000. I was one of the people there that thought that it would. Of course, I wasn't the only one. It was a gold conference, so there were people that thought gold would make it above 2,000, but it was below 2,000. And between that last conference and this one, we've had this explosive rally. You would think, oh, there'd be a lot more excitement, a lot more enthusiasm, but not really. I mean, I really couldn't tell much of a difference between the environment this year and the environment last year. I mean, there's just not a lot of excitement yet in the gold market. despite the fact that gold actually rose almost 4% on the week, it closed at 2,715. So back above 2,700, we're only about $35 below where we were when Trump surprised the markets, or maybe not surprised them, but Trump won. And that inspired a big rally in the dollar and a decline in gold. Well, gold has almost recovered all of that. In fact, if you look at its record high from a couple of weeks earlier, we're only about 2.5% below the all-time record high for the price of gold. And if you measure gold in euros or in British pounds, as a lot of people obviously do, because there's a lot of people that live in Europe or the UK, gold closed at an all-time record high in those currencies. And remember, gold was making all-time record highs in foreign currencies before it eventually started making all-time highs in the dollar as well. And I expect that to be the case. It's just lagging a bit due to the strength of the dollar. In fact, the dollar closed the week at about a 3-year high, I think, in the dollar index. It closed at 107.5. The euro is barely holding on to a 104 handle. It got to as high as 112 not too long ago. And the entire rally in the euro is based on Trump winning. Now, I know we got some weak economic data coming out of the Eurozone last week, especially on Friday. The PMIs that came out were particularly weak, but the US PMIs have been weak too. So I don't think it's really the weakness in Europe. It's the expected strength in the United States that traders believe will be in sharp contrast to what's going on in Europe, because we've got Donald Trump and people assume we're going to have a stronger economy. We're going to have faster GDP growth. Maybe he's going to shrink the deficits. We're going to have a stronger dollar. In fact, people think that tariffs are going to lead to a stronger dollar. I disagree, but that's what the markets perceive. So you're getting this strong dollar. But I think the markets are also overlooking a big factor, because the currency markets, I think, were still trading before Trump won the false narrative that we had a strong U.S. economy, that we had the strong labor market. And that was part of what was underpinning this dollar, because there was a perception that the U.S. economy was in better shape than the rest of the world. And so the Fed would not cut as aggressively as maybe the ECB or the Bank of England or other central banks. But that was a false narrative. The fact that Donald Trump was elected in and of itself strongly suggests that that was a false narrative. Because if the economy was as good as the markets believed, Trump wouldn't have won. They would have elected Kamala Harris. The fact that they voted for Trump is an indication that the voters were not happy. The number one issue in the campaign was the economy. And because Trump won, that means the economy was bad. If the economy was good, Trump would have lost. But it's not just that. They're already starting the downward revisions.
Gold and silver are not merely commodities. They are historical stalwarts that embody the essence of wealth preservation. These metals have served as currencies, stores of value, and even measures of geopolitical influence for millennia. Today, as the global economy faces mounting challenges, their importance is gaining renewed recognition. Let's dive deeper into the multifaceted reasons why gold and silver are poised to play a pivotal role in shaping the future of global finance. The aggressive accumulation of gold by central banks is a trend that has largely escaped mainstream media attention. In 2023, central banks bought over 1,100 metric tons of gold, second only to the record-breaking purchases of 2022. These acquisitions are not accidental. They are deliberate moves to hedge against the instability of fiat currencies. Notable players include China, Russia, and India, nations that are distancing themselves from US dollar dependence. Interestingly, Russia recently announced plans to add silver to its strategic reserves, a groundbreaking development. Traditionally, central banks have focused solely on gold. The inclusion of silver highlights its growing strategic importance, especially as industrial and investment demands surge simultaneously. Why is this happening? The answer lies in declining trust in the global financial system. For example, sanctions imposed on Russia in 2022 revealed the vulnerabilities of holding reserves in foreign currencies. Central banks are now opting for assets like gold and silver that offer autonomy and intrinsic value, signaling a shift away from the dollar-dominated financial order. While central banks are leading the charge, retail and institutional investors have been slower to catch on. Gold-backed ETFs have experienced net outflows this year, and retail buying of physical metals remains subdued. However, this scenario is likely to reverse as economic uncertainty grows. Imagine a scenario where retail investors and central banks are competing for the same finite pool of gold and silver. The ensuing demand surge would create unparalleled upward pressure on prices. Pension funds, hedge funds, and mutual funds, currently underallocated in precious metals, could shift even 1% of their trillions into gold and silver, sending prices soaring. Silver, in particular, stands out as an undervalued asset with immense upside potential. Its current price is a fraction of its inflation-adjusted historical high, making it an appealing investment for those seeking both stability and growth. As industrial demand continues to outpace supply, silver's role in the commodities market is set to expand significantly. Silver's dual identity as both a monetary and industrial metal makes it a standout asset. The ongoing green energy revolution heavily relies on silver for solar panels, electric vehicles, and advanced electronics. This creates a robust demand base that will likely grow exponentially in the coming decades. India's staggering silver purchases, nearly 900 million ounces over 3 years, are a testament to its strategic importance. Similarly, China's active acquisition of silver from Latin America underscores its role as a critical resource in a technology-driven world. Tom Kaplan, a respected voice in the silver industry, predicts triple-digit silver prices in this cycle, a forecast supported by market fundamentals. The structural deficit in the silver market mirrors that of uranium a few years ago. Just as uranium prices skyrocketed from $23 to $80 when secondary supplies were exhausted, silver is poised for a similar trajectory. Secondary stockpiles of silver, which have historically cushioned demand surges, are nearly depleted. When these buffers are gone, the impact on prices could be transformative. The geopolitical landscape is undergoing seismic changes, with the US dollar's status as the world's reserve currency increasingly under scrutiny. The BRICS nations, Brazil, Russia, India, China, and South Africa, are exploring alternatives to the dollar-centric financial system. A gold-backed BRICS currency is one possibility, a move that would further bolster gold's importance. Senator Cynthia Lummis of Wyoming recently floated the idea of revaluing the gold held by the Federal Reserve to purchase Bitcoin. While unconventional, this proposal underscores the growing recognition of gold's stabilizing role in monetary systems. Gold's historical reliability as a store of value makes it the logical choice for anchoring new financial architectures. The future for gold and silver appears exceedingly promising. By 2025, analysts predict gold could exceed $3,000 per ounce, with some forecasting prices as high as $10,000 under extreme scenarios. Silver, often more volatile but with even greater potential, is expected to break through $50 per ounce. In a sustained bull market, prices of $75 or even $100 are entirely plausible. These predictions are grounded in the realities of rising demand, constrained supply, and increasing economic uncertainty. As central banks and retail investors alike turn to these metals, the price trajectory is set to mirror or even surpass past bull markets. The debate between gold and Bitcoin has captivated financial circles, but the comparison is flawed. Bitcoin's meteoric rise has been fueled by speculation, while gold's steady appreciation reflects its intrinsic value and historical resilience. In 2023, Bitcoin lost over 30% of its value relative to gold, highlighting its volatility. Gold, on the other hand, has been a reliable store of value for centuries. It has weathered economic downturns, wars, and systemic failures, maintaining its purchasing power across generations. As more investors recognize Bitcoin's limitations, a significant shift back to gold could occur, further driving its price upward. The window of opportunity for investing in gold and silver is narrowing. As central banks continue to amass these metals and industrial demand escalates, prices are likely to rise. For investors, the time to act is now. Delaying could mean missing out on one of the most significant wealth preservation opportunities of our time. Peter Schiff once remarked, "Gold doesn't just protect wealth, it grows it." Gerald Celente echoed this sentiment, stating, "If you don't hold it, you don't own it." These timeless insights encapsulate the essence of gold and silver investing. Whether you're a seasoned investor or a newcomer, these metals offer a hedge against uncertainty and a pathway to financial stability in an increasingly unpredictable world. By taking a long-term view and understanding the macroeconomic and geopolitical trends at play, investors can position themselves to not only weather future storms but thrive in them. Gold and silver are not just commodities. They are the bedrock of financial security, as relevant today as they were centuries ago.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.